typed, I would have seen the message. So a good day, guys. Like I said, you guys should get your pen and your paper. So I'm just going to be sharing how you navigate through the financial markets the way I do, based on my concept and the concept I trade. First of all, the first thing I'm going to say is it's not a lot, but it is a lot. It's very simple, but it is bulky. So get your pen and paper. I know I cannot talk about everything, but I'm going to talk about the majority. So sit down, chill, get your pen and paper, and watch carefully. Everything I'm going to say is going to be a point. At some point, I'll pause and I'll talk about my trading journey because maybe it's an experience I have that is going to help you. I just want you to pay attention and write down what you have to. So the first thing I'm going to be talking about is identification of key levels. And secondly, we are going to be talking about bias and storyline. Thirdly, we are going to be talking about advanced market structure. Fourthly, we are going to be talking about candlestick structure. Fifthly, we are going to be talking about origin and continuation. Sixthly, we are going to be talking about entries. And then on the seventh aspect, we're going to be talking about risk management and psychology. So I think pretty much 1.5 hours or less is going to be okay for us. So I need to have water by my side because I know I'm going to take a lot. And I'm going to be very snappy. So you need to be at least very quick in catching up with what I'm saying. So I will define everything. I'll be a little bit detailed and a little bit fast. So you need to be very good with catching up. So the first thing we're going to be talking about today is identification of key levels and how you identify key levels. So identification of key levels. What are key levels? Like what are even key levels on the chart? Like I always used to say, key levels are decision points in the market. When you have a key level, it is a decision point in the market. What does the decision point means? When the market gets to a key level, it doesn't mean you must buy or you must sell. Do you get? It doesn't mean you must buy or you must sell. No. It means when the market reach that key level, you are supposed to make a decision. And there are only 3 decisions in the market. 1, are you a buyer? 2, are you a seller? Or 3, are you a speculator? Meaning you are just watching. You are just watching. So there are 3 people in the market. So you can either be a buyer, a seller, or you're just watching. So anytime market gets to any of the key levels we are going to explain, that is what you do. So I have to put this at the back of your mind. So what are key levels? Basically, based on our experience, based on my experience, we have just 6 type of key levels. And the first one is what? Is support zone. The second one is resistance. The third one is a QM, which is a Quasimodo, which is a QM. The fourth one is the SBBR, RBBS, and then the OCL. So these are the 6 key levels we have in the market. And each and every one of those key levels, right? I'm going to show you how to identify them on the chart. That's why the first topic is called identification of key levels. I'll show you how to identify them on the chart. And when you identify them on the chart, what do? I've already told you. You make a decision. Are you buying? Are you selling? Or are you waiting? You are definitely going to do one of these things, right? So a support zone. Remember an explanation I always used to give. All of you are seated somewhere right now. Some of you are at home, some of you are outside. But those of you that are at home, this explanation is for you. So if you are at home now, you are seated inside your room. Maybe you are sitting on a chair, just like I am. And if you are seated on a chair, for example, if you take a look at the chart, let's say this is a house. We have a rectangle like this. Let's say this is a house, right? And this is the roof of that house. Let's say this is the roof of that house, like this. This is a very beautiful house. If this is a house, then you like this, you are inside that particular house. If you want to fly up and break the ceiling is going to resist you. While the floor you are working on is what? Is supporting you. So anywhere on the chart, you should know that support is below the chart while resistance is above the chart. So even if you want to fly, this one will bounce you back. If you want to follow on that ground, the tiles will bounce you. So you keep bouncing in between the house, you will not be able to break through. So this is what we call what? Support and resistance. So support and resistance, support is always below the chart, while resistance is always what? Above the chart. So now on the chart, how do you identify support or what? or resistance zones. How do you identify them? First of all, you're going to have combination of two candlesticks for each of them. I will show you how they look. I will show you how they look on the line chart, and I'll also show you how they look on what candlestick chart. So, what is that about? Now, a support is always below the chart. So you're going to have combination of two candlesticks, which is a bearish and a bullish candlestick. So you're going to have a bearish candlestick like this. Let me do this. A bearish candlestick. And it was also going to have a bullish candlestick like this. This is a blue color. Very good. Like this. A bearish and a bullish candlestick. Now, where the bodies of these two candlesticks meet, the bodies, you are not interested in the wick, where the two bodies meet is your what? Is your support zone. So this is what we call support. Meaning when the market reach any zone like this, the market trade and reach any zone, we are supposed to what? Make a decision. You remember that what key levels are decision points in the market where you are supposed to be making a decision, right? So this is what we call what? Support. So whenever you see a combination of two candlesticks like this, you should pay attention and should know that that is what we call what? A support, right? This is a support. So anytime the market comes to a zone like that, you decide to make a decision. Are you buying or are you selling or are you what? Waiting. Those are the three decisions. So this particular thing, if you switch into the line chart, it's going to look like a letter V. So that's why it is called a V-shaped key level. Once you switch into the line chart, it's going to look like this, V. So when you can mark it out like this. So this is a support. A support on the line chart is a V-shaped key level. So we'll go into the chart and I'll show you just like one example. So let's say this is what a V-shaped key level right here. So this is what is support. So if you come into the line chart like this, you're going to see that it is a V-shaped key level. So this is a support. So whenever the market trades down into this particular area, you are supposed to what? Make a decision. Are you buying? Are you selling? Or are you what? Waiting. So these are decisions you are supposed to what? Make, depending on other confirmations we are going to be talking about, right? So that's for that. So another thing is after support, which we've discussed, one, you know how to identify a support. We're going to be talking about resistance. So resistance is the same thing with this support, but exactly opposite. Exactly opposite. Remember, I said so resistance is found above the chart. So it's going to be above the chart. Just like the other one is below, it is always below. So, but this time around, you're going to have the opposite of this, meaning you're going to be having a bullish candle with a combination with what? With a bearish candle, right? So this is going to be the bearish candle, and you can see it is clearly what? Above. Okay. So this is identification of key levels. So this is it. You have a bullish candle and a bearish candle. So where their bodies meet, right here is what we call what? A resistance. So this is what we call a resistance, and that's where the market is what? It's resisting price. Like when the market comes to that particular zone, we are expecting we are expected to make a decision right here. Okay, we're expected to make a decision. Another thing is that if you go into the line chart, it is clearly going to be seen as what? An A-shaped key level. This is a V-shaped key level, but this one is going to be an A-shaped what? Key level. Like this is an A, so you mark it out like this. So on the line chart, let's go into the chart so you can quickly see it. All right. Okay. Now this is what? This is an A-shaped key level right here. You can see where a bullish and a bearish candle meet. So if you go into the line chart, you're going to see it as an A-shaped key level. So whenever the market gets to that zone, you just don't make impulsive decisions. No, what you do is you what? You make a decision. Yeah, you make a decision whether you are buying or you're selling or what? You are waiting. Now, we've discussed what? Support, we've discussed resistance. What is, before I come to QM, because QM is a little bit confusing, let's talk about SBBR, RBBS, and OCL. But before that, the third one I'm going to be talking about is what? OCL. So let's talk about OCL. OCL are two types. There is the bearish OCL and there's the bullish OCL. Now let's talk about the bearish and the bullish OCL. Now, the bullish OCL, let's talk about the bearish one first since it's already there. The bearish OCL is where you have two bearish candles consecutively printed, one after the other on the chart. Once you have those two candles, now exactly where those two candles meet, right here, where the two candles meet is what we call an OCL. It is also a key level that you make decision in the market. Are you buying? Are you selling? Or are you waiting? Those are the only decisions you make in the market, depending on what the market show you, right? So you're going to what? When the market trades into this particular zone, like this is the OCL between these two, you are going to be making a decision. Are you selling? Are you buying? Or are you waiting? So this is a bearish OCL. Now, the next one we're also going to be talking about is the bullish OCL, which is this. We have this, the same thing, but in a bullish scenario. So I don't have to draw the wicks for this. You know that there are wicks. So between these two zones, there's a bullish OCL. When the market comes into this zone, you're going to be making a decision. So these OCLs you are looking at, they don't really have a representation on the line chart. Sometimes the chart is going to bend small. Sometimes it's not going to do what? Anything. So I will show you them on chart quickly. So right here we have the bullish OCL. You can see it. Right here you also have another bullish OCL right here. So whereas the bearish OCL, we have one right here. We have a lot of them too that you can see on the chart. Bearish OCL, we can have another one right here. Bullish OCL, we have one right here. So this is what? Bullish and what? Bearish OCL. Now, let's talk about, this is the third one. So we want to talk about what? The RBS and the SBR. I want to use all these key levels I've drawn on my screen to explain RBS and SBR. Why? The reason is, anytime a key level gets disrespected, before I even explain those things, let me explain some terminologies. We call the terminologies are rejection or respecting, and we also have breaking or disrespecting. So when we say a rejection, meaning when the market gets to a particular key level, the market used that key level. How would you know the market is using a particular key level? This is the H1 time frame. It's going to be difficult to find, but I will. Now, this is what? A resistance I just explained. So this is a key level. Now, pay attention when the market came to that key level. Market reached the key level and closed below. Anytime the market touch a key level and close below, it is called respecting or rejecting. Whereas if the market close above a particular key level, meaning the body of a candle close above a particular key level. For example, let's take a look at this one. Oh God. This one right here. This candle close above this particular key level, then it is said that the market has disrespected this key level or it has broken above this key level. So anytime the body of a candle, I'll give you guys a little bit of line candlestick representation, which is going to help you. Now, let's say you have a key level here. Now, this candle, we are expecting this candle because this is a resistance zone. And what are resistance basically supposed to be used for? Resistance are used for sells. Support are used for buys, right? This is a bearish OCL used for sell. This is a bullish OCL used for buy. But when the market came, the market pulled back to this key level. Instead of the market to reject from this key level and sell off, market closed above. Meaning the body of a candle have closed above this key level, making this key level being broken. So this key level right here has been disrespected, right? But had it been the market came and closed like this and then rejected from this, then the market is said to have rejected from what? This particular key level, right? So I've explained those two terminologies. We have a break and we have a rejection and what? A respect and a disrespect. Anyone you shall understand. So now the market decided to close above this key level. Now once the market closes above this key level, what do you expect? Market has a week, a very long week right there, another week right there. So now, if the market disrespects a key level that was supposed to be used for sell, which is this resistance right here, then we'll be expecting the market to use it for a buy. So previously, this key level was a resistance, but immediately it got broken. Instead of it to be used for a sell, it's going to be used for a buy. So it is now called a resistance becomes support. So that is why it is called RBBS. Resistance break, meaning the resistance has been broken. Then the second B is becomes support. So immediately this candle close, we'll be expecting the next candle to open up, drop into this key level, and then push up. Then we'll now be expecting it to be used for a buy. So it is now a resistance break becomes support. Do you understand? Okay, the same thing applies to this particular candle. Now, this is a candle that was supposed to be, this bearish OCL is supposed to be used for a sell, meaning we want to see the market pull back into this and then reject and close bearish, or some shall reject. So, but the market decided to push up and close like this above that key level. Once the market closed above this key level, instead of this OCL to be used for a sell, it is going to be used for a buy. So it is also a resistance break, becomes support. So we'll see the market open up and then reject like this. The market to open up and then reject like this. Do you understand? So this is a resistance break becomes support based on the resistance, and this is a resistance break becomes support based on the bearish OCL. So the same thing applies again to what? To SBBR. This is a support, quite alright. But when the market comes, you want to see this support broken. Once the market come and break this support like this, meaning instead of the market to reject and close bearish, the market decided to close bullish, the market closed bearish. Then it's going to be used for what? For sells instead of what? Buy. So we'll go into the chart and I will show you guys a lot of this example. So we'll see the market come back and then reject from this zone, right? So this is RBBS and this is what? SBBR. The same thing applies to this. This was supposed to be used for a buy. Market closed below. Once the market closed below, we'll be expecting the next candle to still come back into that zone, weak it, and then use it for what? For a sell rather than a buy. Do you understand? So let's get into the chart and maybe we'll be able to find some RBBS, SBBR scenario, right? So we'll take a look at some of them when the market is bullish or when the market is bearish. So let's take a look at this little one right here. Now, if you take a look at this right here, you notice that this is what? A support. This was previously a support. If you go into the line chart, you see that it's at V-shaped key level. So this key level here was supposed to be used for a buy, right? But if you come into the line chart, this green bearish candle closed below. And look at what the next candle did. It pulled back up, used it for a sell since it was disrespected and wasn't used for a buy. Do you understand? Then the market dropped back into those key level and used them for a sell. Do you get? So that same thing applies to what? Bullish scenarios. So once you have a bullish candle being disrespected, the market is likely going to use it for the opposing direction. So I don't have to make too much noise right there. So and then finally, the last key level I want us to now use or to now understand is the QM. Now, it is after you've understood all the key levels on my screen that you'll be able to understand the QM. Now, let me explain the QM. Pay attention to this resistance. This is a resistance, quite alright. All of us know that this is a resistance. Now, this is a resistance that got disrespected. Yes. Now, instead of this market to now use it as a resistance break becomes support, the next candle decided to break it down again. So it was originally a resistance, but the market now disrespected that resistance twice, to the upside and to the downside. Then that is what we call a QM. A resistance that got disrespected twice, or a support that gets disrespected twice. So on the line chart, it's going to look like this. It was a V-shaped key level. This is a V-shaped key level. Sorry, A-shaped key level. Market disrespected it to the upside and to the downside. Then this is now your QM. And that is what people call left shoulder, right? So this is now what? Your QM, right there. Right? Market disrespected it to the upside and to the downside. Now, the same thing applies to this one right below here. This one right below here. Market disrespected it. Rather than market to come back and use it for a sell, market decided to come back into it again and disrespect it to the upside this time around. So it is now a QM. It is a left shoulder. So we now expect the market to go back into it and use it for a sell. Its original function was for a sell, this one, right? Market disrespected it to the upside. We expect it to buy. Market now disrespected it to the downside. Again, we now expect it to sell again. The same thing. The original function of this support was for a buy. Okay. Market disrespected it to the downside. We expect it to sell. Market disrespected it to the upside. Now we are still expecting it to buy again. So we're expecting the market to still use it for a buy, right? So this one on the line chart is going to look like this, right? Then you're going to use this, and this is going to be what? Your left shoulder right here. The same thing applies to OCL. Yes. The same thing applies to OCL. Once you have a key level like this, market disrespected it to the upside. The market decided to still disrespected it to the downside. For me, no. Right? When the market disrespected it to the downside, then this is a QM based on OCL. Market can still come back to it and then use it for a sell. And then this is how you can identify all the key levels on the chart. Now, I will tell you about some little things before we jump into storyline and bias. The little things are this. There's what we call fresh and unfresh key level. And we'll go into the chart and we'll talk about it. Now, this is the 1 hour chart. It's going to be very difficult for us to identify so many things. So we'll change the chart a little bit and we'll go into the daily time frame of another different chart. Now, this is the daily time frame of German 40. So we're going to identify some key levels and then I will show you guys some little things. Now, this is what a support by the right. This is what a resistance. This is what a resistance by the right. Okay. So after this ones, you know that this particular one here is a QM. Now, this is an explanation of a QM, why and how. This was previously a support, but market was supposed to use it for a buy, but this black candle pierced through it, broken, came back up again, breaks it again. Then this is a left shoulder. This is what we call a QM, right? So this is a bullish QM. Do you understand that, right? So this is now a bearish QM. This one right here. This one right here. Okay, this is what a key level. Market was supposed to use it for a sell, it refused. It was supposed to now use it for a buy, still refused again. Then this is what a QM, right? This is what an OCL, right? So you're going to see a lot of them, a QM, an OCL, and the rest. Now, what is a fresh and unfresh key level? A fresh key level are key levels that have never been used before, and those key levels are the key levels you are interested in. Those key levels are the key levels we all are interested in because the key levels have never been used before. Do you understand? So, for example, we have this key level. The market has not touched it before, so it is fresh and we can use it. We have this one, it is fresh and we can use it. But if you pay attention to key level like this key level, it's a what? It's a support. And the market has used it before, it has touched it. So you are not interested in this key level anymore. So you shouldn't be worried about it. I'll give the exception. Except if the market drops into this key level and breaks it. If the market closes below this key level and it is now fresh again, meaning the market can still use it for a sell, but it can never use it for a buy again, except it closes above again. So the information is, all fresh key levels are the key levels we are expecting to hold price. And any key level that have been used before, once disrespected, can be used again, it is fresh again. Once a key level has been disrespected, it is fresh again and can be used again. Do you understand? Right. So this is the very little thing I'm going to talk about identification of key level. So quickly, we move to the second agenda, which is what? How do you identify a storyline? How do you get your direction? Now, these key levels are used on all time frames, except lowest time frames like 5 minutes below. But from 15 above, you can very much use them. But the second topic here we are going to be talking about after identification of key level is, this is bias and storyline, which is what we're going to be talking about. So bias and storyline, right there. So how do I get my bias and how do I get my storyline? Like, how do I get my directional bias and how do I get my storyline? First thing first, this is it. If you want to get the direction of the market, you use higher time frames. The monthly time frame, the weekly time frame, the daily time frame, sometimes the H4 time frame. But the time frames you are using are daily time frame, weekly time frame, monthly time frame, sometimes H4 time frame. Now, how is the conventional and the normal way of getting your direction? Now, the conventional way of getting your direction is listing very well. What should I write? Let me write a little bit. You wait for the market to travel to a key level, which is fresh. Wait for the market to reject from that key level, which is fresh. You switch one time frame lower and look for a break of the most recent support or resistance that got created before the market did that rejection. I will explain. Now, we have 3 times frames for getting a direction. We have the monthly, we have the weekly, and we have the daily. Sometimes the H4. These are the normal. This is sometimes. This is not comfort. Sometimes, right? So monthly, weekly, and daily. This is where you get your direction. The most important one is the weekly. That's the most important, and that's the best. And that's why you can see the trade I took on Monday. I'll use this for explanation in this class from this UK 100. It was on the weekly. Very beautiful 1 to 8. Used it to pass my free one. But you see, the weekly is the most important, and then the daily. Monthly is optional, but you can use it. So, if you have a rejection from the monthly time frame, the conventional way, you can have a rejection on any of these time frames. Now, what do? After a rejection, switch one time frame lower and find a breakout, right? Now, what is a breakout? A breakout is valid when you have the market closing below the most recent support or resistance that was created before the rejection. Now, this is that was created before the rejection. This is simple English. You can have a rejection from any of these time frames, monthly, weekly, daily, or H4. Now, let's say you have a rejection from the weekly. I'm following this criteria. Let's say this is a weekly OCL. Now, the market dropped into that weekly OCL and then reject. Once you have this rejection, what do? Look at the English. After a rejection, switch one time frame lower. So this is the weekly key level. Let me write it like this, weekly, right? We have a weekly key level. Now you switch one time frame lower. Now this line is on the daily. And what do? You find a breakout. Very good. Now, what is a breakout? A breakout is valid when you have the market closing below. Let me put or above, right? That depends on direction. Or above. Or above. Yeah. Or above. The most recent support or resistance that was created before the rejection. Keyword. Before the rejection. Keyword. Before the rejection. This is a keyword for you to put inside your head. Now, what does that mean? Once you switch one time frame lower, this most recent support or resistance that was created before the rejection is where you are looking for a breakout, meaning you wait for the market to break above this. Now, when the market creates this, and then the market before the rejection, after the rejection, sorry. Oh God, what am I doing? After the rejection, the market did something like this. This is not a breakout. Why? This is a new resistance that was created after the rejection. But before the rejection, this is the key level. It is when the market break above here that you have a breakout. Then you will say you to have a storyline from your rejection time frame. You are set to have a storyline from your rejection time frame. This is a weekly key level. This is the daily on the line chart. I've explained the breakout. Markets can reject from that zone and break above that key level. That is what is called a storyline. Meaning you have a bullish storyline, right? Weekly rejection and a daily breakout. If it's on the daily, if this key level is on the daily, then you are going to be looking for your breakout on what? The 4-hour time frame. We'll go into the chart and we will explain. But for now, chill. Now, let's now go. That is for storyline. Basically, storyline is created with candle rejection. But how do I get my own storyline? You know, everybody has his own way of doing things. Now, how do I get my own storyline? This is it. I have 5 methods of getting storyline. One is the candle rejection, which I just explained. The second one is the CRT, which everybody knows. The third one is the KLR, which I don't know if everybody knows, which I call the key level refinement. The fourth one is the MRB, which is the most recent breakout. And the final one is the shadow rejection, which is the previous daily high or the previous daily low sweep, which is called the candle rejection. So these are the 5 ways I get my own bias for my storyline, and I use any of them. I will explain them, but I'm going to be snappy. Like I said, I'm not here to waste anybody's time, nor my own time. Now, what is candle rejection? I will explain candle rejection first. Candle rejection is basically what I just explained. How do we get candle rejection? Daily reject daily, H4 breakout, or weekly reject weekly, daily breakout, or monthly reject monthly, weekly breakout, or H4 reject H4, 1 hour breakout. This is just the information. After a rejection, switch one time frame lower and find the breakout. A breakout is valid when you have the market closing below or above the most recent support or resistance that was created before the rejection. Simple. Just get that information and use it. Now, CRT is almost the same with candle rejection. Shadow rejection is the formation of a CRT. So everything are basically linked and they are understandable. Now, let's say the market has a daily key level right here. A CRT is when the market have a bullish candle, for example, right here. Then we now have the next candle open up and then close like this. Afterwards, sweeping the low like this. So this is usually the formation of CRT, right? You have the wick like this. The market reject from a key level and then sweeps the lower close like this. This is what we call a CRT. CRT also have the same rule with this one, meaning you must have a breakout for a CRT to be valid. The same rules, no difference, the same rules, right? That is for CRT. For KLR, how do we do KLR? I'm giving quite some explanation. When you have this daily key level, sitting fresh, it has to be a fresh key level, right? Because we believe that market travel from a fresh key level of the same time frame to a fresh key level of that same time frame. What do I mean? If a storyline starts from the daily key level that is fresh, it's going to end in the next opposing daily key level that is fresh. If it gives a breakout. If it doesn't give a breakout after rejecting from here, it has not ended yet. We keep going. So you understand? We keep going until it has hit another daily fresh key level and give a breakout. So if it is a weekly key level, the market will end in the next weekly fresh key level. All of them like that, like that, like that. Do you understand? All right, now CRT is that same thing. Now, what is KLR? Anytime the market approach a particular key level, only 2 things can happen to that key level. It's either the market respects the key level or breaks the key level. So candle rejection is a theory that says market reject the key level. CRT is a theory that says market reject the key level. KLR is a theory that says market come to a key level and disrespect the key level. What do you do? What do you do? Right? That is KLR. Just know that when markets disrespect a key level and close below the disrespect, you are out of the direction. What direction do you have right here in this scenario? You are bearish. Why the market close below that key level? Yes. Yes, you are bearish because the market has closed below that key level. Do you understand? If you have a bullish key level standing that is fresh and the market came and the candle came close above this key level, you are clearly bullish. That's very simple, right? That's what we call KLR, meaning key level refinement. So what is MRB? MRB means the most recent breakout. Now, the most recent breakout means just you going to the daily time frame or the weekly time frame, sometimes the H4 time frame, and you're just going to look for where is the most recent place that the market break out to, like this. You want to say breakout like this, bam. Then you are there. That is all, which is a very simple method of what? Approaching the market. Just go and look for the most recent breakout. And it's a very simple method of what? Approaching the market. You understand, right? Then finally, shadow rejection. Shadow rejection is very, very powerful. What does that mean? A shadow rejection is different. How do you get your bias using a shadow reject? A shadow rejection means you are using it on the weekly or the daily time frame most of the times. And what do you do? It is the formation of a CRT before the CRT got formed. How? When you have a daily candle standing, pay attention, you have a daily candle standing like this. Then the next day opened. When the next day opened, quickly, the market came down. Sweep the previous low of this candle. Let's say this is the previous low of this candle. Market quickly sweep the low. When after sweeping the low, market decided to close what? Bullish afterwards, taking out the low. What do? Immediately market sweeps the low. That day that the market sweeps the low, quickly go into the lower time frame, and this time around look for a 1 hour breakout. 1 hour breakout. Once you look for a 1 hour breakout, then you are set to trade that day. Why? Because market takes out previous daily low that day. You're expecting the market to trade to 50% of this, or market to take out the previous daily high. This is the previous daily high. That same day. So you have a shadow reject, 1 hour breakout, then you look for your entries, and then you trade down to the previous daily high. So it is just a previous daily high sweep or a previous weekly low sweep or previous weekly high. Do you understand? Now these are the ways I look forward. I look for my direction. So if you go to the previous price action of the week, let's pay attention. The previous price action of this entire week, let's go into the weekly time frame. Sorry, let's look at Euro USD. I think I saw that on Euro on GB. Now on Euro USD, just pay attention. The most recent breakout is you coming into the chart. This is the weekly time frame. You are looking at this is the weekly time frame, or let's say this is the daily time frame. Let's go into the daily. The most recent breakout is to the downside because this is the last breakout the market gave down here. Then you are automatically bearish. But again, come into the weekly time frame now and see why was that week bullish? Because there was a shadow rejection. When the weekly candle opens, it takes out this low immediately. Once it takes out this low, this is the weekly time frame. You switch based on shadow rejection, you switch 2 time frame lower, not 1 time frame lower, 2 time frames lower for you to now get the direction. So you go into the H4 time frame. Once you switch into that H4 time frame, you'll find the breakout after this. Where was the breakout? The breakout was here. Where did the entry came from the entire week? Right here. And this is advanced market structure, which is the next thing I'm going to be talking about. That is why the week was bullish. What do you have? Shadow rejection based on the weekly time frame, and the same thing happened even on the daily time frame, which was a shadow reject. But this time around, this is not a shadow reject, it has become a CRT. I'm not trying to make things complex for you guys. No. I'm not trying to keep using terminology. No. I'm trying to give you an explanation based on exactly what is happening so that you understand it. Terminology doesn't matter. Just know that because there was a sweep of that low, the entire market structure is bearish. Everybody knows. We are clearly bearish, but that's your bias. Using shadow rejection has given you the opportunity for you to take a buy or a sell because you have the previous daily high or daily low sweep. Before that day candle close or before that weekly candle close, you want to see your entry that week. I've always explained this. After a rejection, the normal way people do it, after a rejection, you wait for the candle to close before you look for a breakout. That's what people do. And that's the normal way. I don't wait for candle to close. I've been teaching it for a while, and you can see the results, right? I don't wait for candle to close. After a rejection, I look for a breakout. That day that the candle is rejecting. You know, there are 2 different words between rejecting and rejected. Some people wait for the candle to have rejected. I don't wait. I trade when the candle is rejecting. As far as it gave me a breakout, then I'll be a participant that particular day. But that's how I do it. Everybody can do it his or her own way. Do you understand? So that's basically how you get direction. I don't know if I can establish any bias for you guys on the chat, but basically you can see rejection. Let's use that. Okay, let's I don't know if I can do that, but this is a daily reject daily. Let's just use this. This is a key level that is fresh. Market drop into that key level and rejected. So this is a daily reject daily. So this is a daily key level, right? After the rejection, for our breakout, right? Now, this is where the market rejected, right? And this is where the breakout happened. Because this was a fresh support zone that was created before. Keyword word, before. It's a fresh key level that was created before the rejection. Because this is where the rejection started happening. So when the market break above it, you are said to be bullish. And your storyline is clearly bullish. Do you understand? So before you even create this storyline right here, you must have already had a setup here because you understood what we have been doing. Do you understand? You have understood what we have been doing. A very, very simple approach. All right. So that is basically how you get your directional bias. Now I'll use an explanation for directional bias, the way I got my direction this week, but the direction ended when the market get to what this zone because we trade weekly to weekly right there. Now, if you look at what happened, look at the week of the previous candle before this week, drag back, you notice that this particular week, last week was rejecting from this key level, right? I'll put it on this. This key level was where last week was rejecting from this place. So you have a weekly rejection. And when you drop into the daily time frame, you notice there was an entire different storyline here. How was that storyline? Look at this OCL right here. So market came and rejected from that OCL. So we have a daily reject daily right here. When you drop into the 8-4 time frame, after the rejection there, which is here, right? This is where the breakout happened, telling me that I am bearish. But then I now took my entry from here. Everybody that know me knows this was my first trade of the week. Daily rejected daily, each for breakout, sell from here, and then we drop down to what? To the external liquidity. This was the first trade I took this entire week. So this is a method you can get what? The direction. And I've explained all the methods, KLR, CLT. I'm not like making a lot of noise. You understand? Right? So that's for this particular one. Okay. Another one is the next thing we're going to be talking about is advanced market structure. So quickly, we're going to talk about advanced market structure. Now, after you've gotten your direction, we have to talk about advanced market structure. So, or is it that we should go for a break? You guys need a break. We're already like 45 minutes into the class, so you guys like need a break or something, right? Telegram